Hey everyone, and welcome to This Explainer. Today we're unpacking the fascinating and honestly, often completely misunderstood world of fund pricing. You know, if you've ever stared at a fund's quote sheet and just felt kind of lost in that massive sea of numbers and acronyms, trust me, you are exactly in the right place. We are going to clear up all that confusion today. All right, let's dive right in with a question that challenges a really common intuition. If two funds hold essentially similar assets, but one costs $10 a unit and the other costs $100, is the cheaper one a better buy? It is so incredibly tempting to treat investment funds like items on a grocery store shelf, right? Where a lower price tag just automatically feels like a bargain. But here's the thing. In the financial world, relying on that everyday intuition can actually lead you totally astray.
So, to answer that question properly, here is what we're going to cover today. 1. Demystifying net asset value. 2. The mutual fund myth. 3. ETFs and their two different prices. 4. Premiums and discounts explained. And finally, 5. Investing with NAV in mind. Let's get to it.
Okay, kicking things off with our foundational concept. Section 1. Demystifying net asset value. What exactly is it? So, NAV is essentially the intrinsic value of a single fund unit. It's calculated directly from the total equity of its underlying portfolio at a very specific point in time. And listen, this isn't some arbitrary price tag cooked up by a marketing department to sound good. Rather, it is a strict mathematical reflection of what the fund actually holds on its books. Think of it as the ultimate reality check for a fund's worth. And the math used by fund accountants to figure this out is surprisingly simple. You basically just take the total assets of the fund, subtract the liabilities, and divide that by the number of outstanding shares. For mutual funds, a firm's middle office calculates this right at the end of each trading day. They are carefully factoring in the whole shebang: capital inflows from new investors, outflows from people cashing out, daily gains, daily losses, and operational expenses. So when you look at an NAV, you're not looking at a guess. You're looking at a hard, meticulously calculated number that represents a specific slice of a massive pie. Which brings us to the biggest misconception out there. Section 2. The mutual fund myth. Price versus value. This right here is absolutely crucial. A 40% gain is exactly the same percentage return whether your starting NAV is $10 or $100. If you invest $1,000, you either get a heavier stack of cheaper units or you get fewer of the expensive ones. The absolute value simply doesn't matter for your returns. If the underlying assets grow by 40%, your $1,000 becomes $1,400 either way. A lower NAV absolutely does not mean a fund is cheap or somehow has more room to grow than a higher NAV fund. The underlying assets do the growing, not the price tag. Oh, and while we're at it, we need to completely bust the dividend myth too. A higher dividend percentage on a higher NAV fund does not mean you are getting more value. It just proportionately reduces the fund's overall NAV. When a fund pays a dividend, that cash literally leaves the fund's asset pool and goes into your account. So a 20% dividend on a $100 NAV fund reduces the fund's internal value in the exact same proportional way it would for a $10 NAV fund. It is literally just moving money from one pocket to another. It's definitely not free money generated out of thin air. All right, let's shift gears a bit. Section 3. ETFs. Two prices. NAV versus market price. This is where things get a little more complex. Unlike mutual funds, ETFs actually have a bit of a split personality. They have two distinct prices running simultaneously. You have the internal fund value, or NAV, which is usually calculated after hours, and then you have the live, minute-by-minute market price trading openly on the exchange. This dual pricing, this is where a lot of investors get tripped up. The NAV tells you what the underlying portfolio of stocks or bonds is fundamentally worth. But the market price, that's the actual tangible cost you pay when you hit that buy button on your phone during active trading hours. During the trading day, things get wild. Active trading, shifting liquidity, and bid-ask spreads basically act as a massive tug-of-war on the ETF's market price. Because it trades exactly like a stock, its market price fluctuates based on live buyer and seller sentiment. If everyone suddenly wants into a particular sector, they buy the ETF, driving its market price up immediately. And that happens even if the underlying assets haven't officially updated their priced value yet. Basically, the official NAV always lags behind the real-time emotion of the market. And that divergence leads us directly to two vital terms you're going to see on an ETF quote. Section 4, Premiums and Discounts. Mind the gap. First up, the premium. If optimistic investors aggressively bid up an ETF much faster than its underlying assets are rising, the ETF trades at a premium.
Basically, you're paying slightly more for the ETF share than the carefully calculated value of the stuff inside of it. It's literally like paying $102 just to buy a physical wallet that only has exactly $100 inside of it. You're just paying extra for the convenience of accessing those assets right then and there. On the flip side, we have discounts. Aggressive, panicked selling can push the market price below the actual asset value. Now, you might immediately think, fantastic, I'm buying $100 worth of assets for just $98, what a steal. But hold your horses. As we'll see, a discount isn't always some magical bargain waiting to be scooped up. Very often, it actually points to severe underlying friction in the trading mechanics.
So why do these gaps even happen? Well, usually it's because the ETF and its underlying assets are sitting in completely different liquidity pools or time zones. Now, normally, specialized institutions called authorized participants, or APs, step in. They act like highly efficient market mechanics to create or redeem shares and instantly close that gap. They arbitrage the difference to keep things aligned. For example, if you trade a European stock ETF in New York, the London Stock Exchange closes way before Wall Street does. The ETF's market price keeps moving with US sentiment, but the underlying NAV relies on stale, closed European prices. That gap naturally closes when both markets open the next day, but severe global stress can totally upend that delicate balance. For a really stark, real-world example of when this normal plumbing just completely breaks down, let's look back at the 2015 Greek market crisis. During this event, the underlying market in Athens was halted entirely. Nobody could trade the actual stocks. Zero liquidity. Yet, the ETF tracking those stocks continued to trade freely over in New York. The extreme volatility forced managers to actually step in and block redemptions entirely to protect long-term investors from manipulated pricing. It vividly shows us that premiums and discounts can persist heavily when the normal plumbing of the market gets blocked up. Okay, so let's bring it all home. What should you actually take away from all this highly technical pricing data? Section 5. Investing with NAV. Practical tips. Ultimately, here's the secret. You should just ignore the absolute NAV of a fund. Whether it's $10 or $1,000, it simply doesn't dictate your future returns. Instead, focus entirely on long-term compound annual growth rates and the actual quality of the portfolio. For mutual funds, look deeply at the manager's historical track record over multiple market cycles. Use systematic investment plans, or SIPs, to automatically invest fixed amounts. That averages out your costs over time so you aren't sweating the daily NAV. And for ETFs, always try to use a limit order near the stated NAV. That way, you won't accidentally overpay and get stuck buying at a steep premium during a wild market swing. So now that you know the objective truth behind the numbers, how are you going to look beyond the price tag to evaluate your next big fund purchase? Just remember, in the world of funds, true value is absolutely never found in a low absolute price. It's always found in the quality, consistency, and performance of the underlying portfolio. Thank you so much for joining me for this explainer, and hey, happy investing.